Well, hello, everybody. Welcome to the Monetized Advisor, brought to you by our great friends, because we're one of them at JPTD Partners. This, of course, is a podcast for you as financial advisors who want to build, who want to protect your business, but also ultimately build valuation to monetize the practice that you work a lifetime to build. I am Peter Velarde. I'm one of the partners here at JPTD Partners. I am, of course, the P in JPTD. We're not terribly creative with branding. And with me is my good friend and colleague who represents the P in JPTD, Mr. John Poole. John, say a quick hello to our guest today.
Hi there, and I represent the J, not the P.
Oh, the J, that's right.
Great
Again,
to be here.
not great at branding. So, yes, so that's what we are all about, is to help you. John and I both have 40 years in the industry on all sides of this, and want to help you avoid mistakes and to optimize both your growth stage and your exit stage. So today we got a fun afternoon plan or morning, depending on where you're at. We're going to spend a few minutes up front on news that you can use. So we're going to start with a couple of article reviews and kind of draw some conclusions out of that we think will be helpful for you. But the real meat of today is kind of the anatomy of a deal, and that is, what are the processes that get you to the promised land of finding the best and last strategic partner of your career that can help you accomplish all the things on your checklist, including monetization or taking some chips off the table. So we'll walk you through kind of phase by phase what happens and what should happen. Then we'll shift into what we call the advisor red flag, which is we kind of pick one mistake that John and I see in all of our work with clients that we want you to avoid. And we'll get to one of those and kind of vet that out together. Then we're actually going to walk through a real offer. So I have one recently I thought you'd have an interest in seeing. We'll walk you through the mechanics of it, the structure of it, so you can get an idea of just what one slice of life looks like for a practice a certain size and certain structure. Then we'll do some rapid fire, just kind of conclusions and wrap up and get you out of here. So, John, you ready to have some fun today?
Yeah, looking forward to it.
Cool. So, first article is by, it's called Why Ownership Structure Matters to Independent Advisors. And this was by a guy named Jeremy Robson. And this was interesting, John, I thought, because I
hmm
think one of the things that we spend a lot of time looking at is fit. And part of the fit is what type of structure might be the best fit for one of our clients. But what did you glean out of this article, John, in terms of why structure maybe matters?
Yeah, I think most importantly out of the article, what jumped out is that not everyone understands what they really have in their practice and the ownership structure that they currently are under. There are some, for example, that think that they are independent and they own their book, and when you uncover some of the layers, you find out, well, maybe they're not independent, and maybe they don't really own that particular book. And
Hmm.
then there's the ownership of where a firm has multiple advisors, let's say, and let's say it's myself, and then I've got three junior advisors with me, and if I'm not if I'm not in control of the equity of that practice, the ownership of that practice, and they are, and they've got business running through it, I really don't own that full book. I really only own my clients in that book, and there's a lot of pitfalls that can come into play there uh, if they don't pay attention to what do they really actually own. And keep in mind this, it's like the Brooklyn Bridge. Unless you own it, you can't sell it. So
Hmm.
you better make sure that from a structure perspective, you have that ownership. The good news is that especially in that latter example that I had, when you've got a practice where you've got a senior advisor and they've got three people out there that are doing business for them, that bringing in new clients, servicing existing clients, that kind of thing. Good news is that you can change that structure, so that you can actually own and make sure that that book is held appropriately by yourself.
Yeah, those are great points. I'm glad you started there, John, because the sell side structure is critical. That was part of the article. And as John said, just being aware of what it is, what you own, and having time to prepare to say, is this the optimal structure, or are there things I could be doing to optimize my structure for valuation, not just growth and earning an income? I'll address the other side. It's also in the spirit of fit to evaluate really the structure of the buying organization or the strategic acquirer, strategic partner. There's all shapes and sizes out there, John, right? You've got
Hmm.
private equity backed companies, family office backed company, mutual companies. You've got sovereign wealth. You've got private capital. So looking under the covers to evaluate, well, what is the capital source of this? What have they done with it in the past? Is this, for example, traditionally, private equity looks for some type of monetization event themselves over about a 5 to 7 year period, whereas family office tends to be more long term. They tend to run, they tend to be more patient capital, for example. And there's lots of shades of gray. It's not the only consideration, but it is a big part of evaluating what might be the best fit for me. So hopefully that was helpful. John, anything you'd add to that in terms of this article?
Yeah, the only other thing I would add that would be on the from the purchaser side is paying attention to when they want to when they want to issue stock. Is it everybody has one type of share, or do we have multiple types of shares?
Hmm.
In other words, does private equity have one type of share and I don't have that same share? Well, you don't expect the monetization to be the same in that case. So you have to make sure you do your due diligence to understand, is there one type of equity in this business, the acquiring business, or are there multiple stages?
Yeah, that's so important. Generally, you're going to want to have partner with a group that is one share class because then you know that everything is aligned up and down. Not always, but most of the time. And another
Mm.
subcategory of what John just said is that the more partner owned or advisor owned the firm is, the more empowerment you will have to influence the growth of the equity, which is important because swapping some of your equity that will be valued X is generally a good idea to swap it with the acquirer's equity, where it'll be something much higher than X and likely growing faster than yours. So these are some of the nuances where advisors make a lot of mistakes up front just on fit. Okay, let's go on to article number 2. This one is all about the power of an integrated firm. So there's aggregators, there's integrators, there's all sorts of designs. There's partial, majority, full deals, minority deals, every shape and size is out there. But there's a category of firms called integrators that basically believe that if they provide a family office like set of systems and suite of deliverables to a client, that will expand the value to clients. And that's probably a good idea with the changing sand that we have now, especially with kind of the dual edge of AI. But John, what were the headlines of what you get out of this article? This was written by Joseph Principe, and it's all about delivering advisor alpha in the age of automation. So this really gets at the AI piece of this, that in this world of automation, which is a good thing, that increases value of your practice. In the end, if you've got systems, redundancy, and the business depends less on you. But what headlines did you withdraw from this, John?
Yeah, there's a couple real quick. One is that, clients want to be or excuse me, advisors want to be the quarterback. They want to have impact and have say and be in control of it. And it makes perfect sense. Um, what you're doing from a planning perspective, what you're doing in managing a person's wealth, having that ability to control what is occurring for clients gives them the most benefit, gives them the most comfort, gives them the most as far as the outcome is concerned that they're trying to achieve. So that's one piece. And then the second thing is that they clients don't want separate advice from various different entities. They like the idea of having that one quarterback, having that one place where they can go, and knowing that advisors that are in environments that support that is important for the long-term aspect of the business.
Yeah, that is so true. And there's this kind of interesting dual edge of AI, right, John? It's on the one hand, those of you out there that consume it use it to create more value to your clients, create efficiencies, create valuation, because you can make the unpredictable more predictable. That makes you worth more. But on the other hand, we're both seeing some fear out there. We're seeing advisors worry, and it's been put to me a couple different times where advisors, when I ask them what's the fear, the advisor might say, even right now as we speak, AI can probably deliver 5 out of 10 things that I do right now. So is it going to be harder or easier for me to charge my 1% fee? This is what's on everybody's mind. So the term that is the response to that, what do you do to combat that relevancy risk while you consume AI at the pace and the rate and the way that's best for your business? How do I do that? And the whole industry's answer right now is value expansion. So if you interview the uh, top RIA CEO or C-suite people, top Barron's 200 that are private equity, private capital, family office backed. If you interview those CEOs, they'll say the industry is consolidating and there's only going to be 20 of the top 200 left standing. And the ones that are going to win are the ones that have created some version of a family office deliverable for high net worth and ultra high net worth clients. And it's going to have to be a one-stop shop. So, John, I'm thinking over time that the deliverables that advisors deliver is going to shift from an asset allocation pie chart to something like what you said, being the QB, being the point guard that orchestrates a set of resources that are one place they can get. I think that might be a pretty big change for some advisors, John.
Yeah, I think so, and I think just like what we've seen in our tenure in this industry. When we first started out and people were selling 8% loaded mutual funds,
Hmm.
that the margins get shrunk. You couldn't sell that today. Um, but the margins shrink. But the good news is that those that are providing value, well, they get to provide more value because things are made easier for them, things are made quicker for them. That affords them the opportunity that when margins shrink, I expand, and I expand well beyond what those margins are shrinking, versus those that just sit there and wait for it to happen to them, and they end up on the shore somewhere.
Yeah, you're absolutely right. And at the end of the day, it's really about your choice set as an advisor. You have the choice to continue going at this as you have, kind of alone as a business. The headline there is if you're going to do that, great, but you will have to invest and create infrastructure that delivers more value in order to compete. Just like when the hardware industry consolidated, as did the dental industry, medical industry. As all these industries consolidate, you have to have an eye towards who's going to clean my clock. And if Home Depot and Lowe's are in town, somehow as the hardware store on the corner, you've got to create this expanded value prop to make sure they keep coming to you versus going into a Lowe's and having everything in one place with contractors there, the truck to deliver it, all in one stop shop. So that's where the industry is going. And then on the other hand, you might want to say, well, rather than investing all that into my own infrastructure, maybe I partner up with a firm already had built out that infrastructure and leverage theirs while also taking some chips off the table at all-time high M&A values. And oh, by the way,
Mm.
maybe in doing that, I can also build a stronger succession plan and build a core of G2s to serve my clients. I haven't quite solved that. And maybe I don't love exactly what I'm doing. I'm doing too much. Maybe I want to get some things off my plate and kind of redefine my job description. So that's kind of what this said to me. So thanks, John, for that. Let's move on to the anatomy of a deal. Let's kind of walk through the processes or the phases of a deal to not necessarily make sure you land with the highest math equation, because once the deal is done and you're doing what you've been doing, but with a strategic partner, it's all about, did what you expected to happen and more. So, John, I think the first phase by far is happens way before the deal happens, right? So it's we meet an advisor and we kind of test for, what conditions are in place that get that practice prepared for a deal. Maybe you can start there and just share a couple things about what you're seeing and we're seeing are really important things for advisors to think about to prepare for a future deal.
Yeah, it does. It definitely starts way in advance, and it starts way in advance from a perspective of, okay, back to what I was mentioning earlier about ownership. How are things how are things owned? And if they're not correct, then making those corrections in advance of taking something to market. So it's important that structure is addressed. It's also important that they understand what their numbers are and where they're coming from. Um, Nothing's more difficult than having to overcome the fact of when they're asked a question about their practice and they're like, I don't know. That doesn't really sell that well
Hmm.
in the marketplace. People are expecting them to understand their business, understand the way in which they're able to drive their profitability, understanding what they're doing as far as growth is concerned, and at the same time pulling out the, oh well, I've got this Oriental rug in my office that happens to be in the den of my house for right now, but it's on my books for an Oriental rug that I bought. Country club dues, whatever. Getting the true what is going on in the business and the practice and getting it prepared up front before any deal is ever done, and making sure that in advance they also understand the difference between an equity deal and a transition. All advisors, it seems, are familiar with, okay, well, I'm going to take a trans comp and I'm going to move from A to B to C to D, and I'm taking these forgivable notes during that period of time. It's not that a forgivable note's not part of a deal. It could be part of a deal in an equity event, but it's not the same as an equity event. The equity event is I'm actually selling my business, and it's understanding that this is a business. This is an entity that I'm selling.
Yeah, I think that's the most fundamental message we want you to hear is that it starts with kind of a mindset shift, right, John? It's that I'm not trying to build a practice. I'm really trying to build a business. And if I'm going to build a business, what would a business owner be thinking to prepare for an exit? What would I be thinking? What would I be doing about what I'm thinking? What do I have that I need to keep doing? And what do I need to change to prepare myself for that? And there's a whole list of things that we can talk about. I would just break it down to, a part that should happen with all of you right now, and that is the mindset shift as a business owner that you're not just playing for serving your clients and earning a good income. And it's fine if you don't want to have an exit, but when you see the kind of valuations we're seeing out there, you're going to want to have a heads up about it. Because for most advisors, John, they kind of face I guess, the cold, hard truth that they wake up one day and they're like their worst client that has 90% of their net worth, which is the business, tied up in their one asset. Talk about asset illiquid concentration. If you had a client like that was an SMB client, you say, whoa, whoa, fire alarms start going off, and you're saying, hey, we got to address this now. What happens if a downturn in your, practice is worth half of it? What if principals get sick? We see it all the time. We've had clients pass away. We've had clients, have to hand off something to a family person that wasn't prepared, and it plummeted the value of their business. All sorts of things represent the certainty of uncertainty, right? But part one is kind of the mindset shift. I'm building a business. What are the drivers of valuation? We've got lots of content on jptdpartners.com, our website. We've done a lot of workshops on things you can do to build valuation. We talk about that just about every week with our clients. So if you want more information on that, you can certainly book a call with one of us, but lots of content online that you could look at. But the other thing that you hit on, John, is not just about the mindset and putting systems in place, making sure that revenue growth and EBITDA growth become more predictable. The more predictable they are and the faster it's growing, the larger you're going to get because that matters. But also, you're going to be viewed as being a growth acquisition, and where there's going to be high faith that even if you were to take a full deal, most of the full deals, you will have more than enough to not only retire, but often pass on some generational wealth. So, what they look for is the people, if it's the right fit for them and you, that want to grow beyond that. And the best indicator is that you've grown in the past. So all that is part one. Part two is simply more shorter term, is to make sure that you have the optics of the right type of practice, in this case, business, which means collecting financials, understanding your EBITDA margin as a percentage of your gross revenue, things like that. But starting to really say, hey, if I were to lift up my kimono and show everything, how do I look? Do I look like a business? Do I look like a practice? Or do I look like an owner that doesn't have a clue? So I'm thinking that's pretty important for phase one. Anything else on kind of the prep piece, John, that you want to add?
Yeah, the only thing I'll dovetail on what you mentioned there, and that is they have a tremendous amount of their net worth that is tied up in their business. Most people we find, most of our clients, once they find what their business is really worth, are shocked by the valuations. And it's that shock that they think they're worth X, and now they find out they're worth Y. All of a sudden, I didn't think that was that big a chunk of my net worth, and now it's a huge chunk of my net worth that's tied up in that business. So, just like they do with clients, and they see clients all the time, that business owner clients that are selling and monetizing their business, they're now putting that same hat on themselves. And what would they tell the client that has 95% of their net worth is tied up in the practice? Well, you got to do something. You can't just sit there and let
Yeah.
it happen. And I love the fact too that you were talking about that growth aspect. You know, there's in this in the wealth management space, there's just the one thing that a purchaser cannot control, and that is um, what is the business? How's the business going to perform after that transition has occurred? They can take a look at it, and there's three things. A good friend of mine likes to use three all the time. I don't know who that guy is. There's three things out there that are important. One is I can't control the client staying with me. There's no contract that says that the client's going to stick with me. The client can have a bad burrito for lunch and they take off. Well, I keep the assets here because A, I'm staying here, or I've got a staff that's going to continue to stay here, so I'm making that transition. B, I'm growing. I can show that my business is growing and it'll continue to grow even after an acquisition is concerned. And C, that I am going to be sticking around for quite some time, and I'm not doing this out of a fire sale. I'm doing this out of a decision to make the best impact for the
Yeah, all
future.
that is true. And for those in the audience, we're kind of spending more time or disproportional time on this prep stage because it's everything. It really is. And so if you measure twice and cut once, the outcomes will be better for you, for your clients, and everybody around. So that's phase one. Phase two is what we call the dating game. It's who do we date? Why do we date them as opposed to some others? And the goal is to only be talking in the marketplace with potential strategic partners that have the right fit for you, for your clients, for your staff, and that checks the most, if not all, boxes of what are things that are important to you at this stage of your life and career. So, this is where so many advisors go astray. typically the way advisors independent of us would get introduced to one of these strategic partners is they get solicited, they seem like good people, they're smart, they're flattered that they want to buy them out, they go down kind of the whole path of exploring it, they get an offer, maybe they get one or two offers. What they don't know, they have no idea as advisors as to whether I'm even talking to the right two people. For example, we've been doing this for 100 plus years together, right? So, all right, if that's the case, collectively, then, what do you know that I don't know as an advisor? Well, we know, for example, we've got relationships with 110 of the best acquirers out there at any point in time. We have a whole staff and we full time are evaluating those options for you to make sure that we can handpick not the top 20, but the top five that are going to be right for you. So I can't even imagine an advisor, John, trying to do that on their own because we see all sorts of sharks in the waters. We see people talking to a partner that has only a certain type of deal that isn't right, or maybe it's an integrator and they really need an aggregator, or maybe they need somebody who's family office backed. Maybe they need a great minority deal, not a full deal, but they're only looking at a full deal. So, John, we see a lot of mistakes in this area. Any others that you'd like to highlight before we go over the other phases?
Yeah, the other thing that to add on a dovetail to that is, when they start to get those, the
Flattery
flattery
cops,
comes,
exactly.
and the thing that the thing that um, you have to make sure is it is the right fit. Don't worry about the economics. The economics will come. And what you're going to find is that most firms, when they're doing that flattery, they're throwing numbers. And the numbers may be the absolute wrong numbers for you, or they may be the right numbers. I don't know. You don't know. It's not until you find out is it the right
Yeah,
fit
that's so
and then
important.
work the
So
numbers
phase two
appropriately.
is really important. You shouldn't be dating people. You shouldn't be doing that with these companies unless you've come up really first with your assessment of what you want and what might be the right fit for you, and then only talk to the ones that you know up front are worth the dating and worth the time, and have a lens and a process to do that. That's what we do for our clients. I'll kind of go through the rest of phase three, four, five, six, and hit on just a couple points with each of them. So, phase one is all the pre work to be done. Phase two, again, is finding the right buyer pool to even talk to. Phase three is having a process to process the offers that you get. And a lot of advisors fall on their face here. Most important thing here is to have a process. For example, we grid out all your offers against your criteria and help you compare and contrast them. So we do that, and that's part of how we get you to the finish line. But if you do it yourself, you need a criteria. Just like if you were to go through a career change and you were to say, I'm not sure which career is right for me, you have to put it against some lens to evaluate, some criteria. That's really, really important there. Fourth phase is negotiating these offers. This is where advisors don't really know what they're doing. That's fine. This is our world. This is not your world. I couldn't be a great financial advisor right now. I used to be. John was as well, but it's not what we're doing currently. In terms of creating more market value, there's so many tricks up our sleeve that are the right things to do for everybody involved. We're always looking for that win-win-win. But John, what do you think is the biggest mistake advisors make in this fourth phase of, negotiating greater market value? I have a point of view, but I'd love to hear yours.
Yeah, I think to me there's a few things that jump out. One is that they make ridiculous the requirements for a deal to get done. So they really just throw across an insult to the acquiring firm, and it shuts everything down. That's one. Two is that it gets to when I'm doing this by myself and I'm out there doing this by myself, the problem that they don't recognize to begin with is, all right, well, I'm going in and I'm negotiating, and this is back and forth and back and forth. The problem that they have is that come Monday, we get a deal done on Friday. Come Monday, I'm going to work with the people that I've just been in beating on each other, it's a lot easier when they can defer that and say, you know what, that Peter Velarde guy, he was a real turd. I didn't like working with, and you can say, yeah, I didn't either. But knowing that we were doing it for their best interest, so being able to offload that is, I think, a big benefit because you're going to be working with people. And then I think the last thing is that it really comes back to, am I talking about the uh, am I negotiating? Is it more the upfront? Is it more equity? Is it more earnouts? What am I doing? And having that design based upon what's best for me, knowing that the firm has a certain caveat that they've got for a deal structure, making sure that
Yeah, that's
that's
so
best for
important.
me, that
That
I
we
win
call
in
the
that
air in the
equation.
balloon. So, the art of this, there's a science to it and there's an art to it. We have some clients that will accept a lower valuation in order to get the air paid out in the way that they want to, and or find the right strategic partner that can help them grow faster, that has more of the terms that they want as well. So there's the air in the balloon. Let's get as much air in the balloon as we can, and we do that on your behalf. Second is to make sure on top of that that the air is pushed around in the way that's optimal for you. And often it's also an issue of customizing it per each partner, because you may have a partner that's closer to retirement, has a different need for when they want that air. Traditionally they want more upfront because they're closer to retirement, whereas the G2s or a younger partner that has a longer runway may want more of a form of that air to come and pay out, and equity growth on the back end, which is where a lot of wealth is created in these deals. So it's all about that, and it's all about thinking about, as John said, the aftercare. So what do you need once the dust settles? You got the money in the bank, you've closed, you paid the tax man less than if you earn the income, but you still pay the tax man. When all that's done, it's what is the working relationship and what do you need for the rest of your career? And that's all the work up front to make sure it's a good fit. So that's stage 4. Stage 5 is once you come to a choice on the firm out of the 5 you want to go with, there's a period of time called due diligence. And this is where you're engaged now, you stop dating the other firms. And that period is anywhere from a month to 2 months on average. We have some that'll close in 2 weeks and some that'll close in 3 months. But it's about an average of 2 months. And during that period of time, you're sharing detailed information to prove that what you said is true in essence, and it's not hard. And you're also going to be talking to departments. You might visit their home office. You might talk to advisors that have done deals with that firm like you, or even from your firm. So this is a period of time just to confirm. And most people go to the altar, just like in marriage. Let's say we close 95% of the deals of the LOIs that get signed through us because we know all the pitfalls. And this is where you would retain a really good attorney from our approved list. But John, any quick pitfalls that you see? Like, what's the biggest mistake you see advisors making at that DD stage?
Yeah, one is not being conscious about what they're what are the important aspects of the deal structure, the making sure that they're conscious about those aspects, and making sure that they're represented appropriately. It's not going to be my cousin Vinny's attorney. That's the best choice for me in this equation. I need somebody that understands mergers and acquisitions, and in particular, is even more beneficial. I need
Yeah,
somebody that
that's a huge
understands mergers
mistake,
and
and
acquisitions in the wealth management space.
we have a really good list of approved attorneys that tend to keep costs reasonable for our clients, that we know will get you to the finish line. In some cases, have even closed deals with the acquisition partner that you have as your first choice, so they understand their paper, which really helps move things along because they know the pitfalls and challenges to protect you. So most deals go to the finish line, and it's a very natural process. They'll meet with you once a week to go through all these milestones, and we're there to help you to get through it. And then the last part is, or phase 6, is really what we've been talking about is the aftercare. And that's making sure that you find the balance between two things. One is, what do you keep doing exactly the way you've been doing it? These firms generally don't want you to change everything. They want you to keep doing what you're doing because they wouldn't have acquired you if you weren't successful in doing it. But then looking at their firm and their infrastructure and their departments or centers of excellence and saying, wow, this is kind of like a menu where if I need this, I can pull that. So it's all about change management post deal and finding the right art of doing what you've always done, but as quickly as you can to figure out how do I prioritize all these areas? Is seeking capital for an acquisition my priority? Is tapping into their marketing organic growth machine? Is it their operations center where I can get a bunch of things off my plate so I can do more of what it is? So John, that's what we see, and that's what we help our clients navigate every day. And I'm gonna actually skip over a part because I think we hit it so hard, and that is biggest mistake we see with advisors in this process is thinking of it as just a transaction, as a monetization event to get as much cash up front as I can. And that's a big mistake because you can get a bunch of cash up front or get a very high multiple, but it not being the right fit, and it'll be a disaster for you. So it's really important you kind of hear from us that there is a process. Trust
Mhm.
it. We do. We know it works. We've been doing this a very long time. We close more deals than anybody out there. But if you trust the process, including it's going to feel a lot at some points like you're drinking from a fire hose. It's going to be overwhelming. And there's an emotional part of this too. Let us help you get through that as well, because you don't want to get cold feet and make a decision on pure emotions. You want it to be logic, fear, and emotions. And you want data to rule and track records rule, but you don't want to miss an opportunity because you become like your worst client and get paralyzed. So it's very important that you are self-aware throughout this to see if you're saying yes or no to things because it's truth or because you just feel that way from whatever past conditioning that you've had. And we've worked with a lot of humans doing this, and we know that that's as much an important factor to do it. So let's get to an offer, John. I think that will be fun. I'll kind of share the terms of the offer and a little bit of the background, and then John, if you want to pipe in and kind of share your lens on this. But this is a recent offer. This is for a practice that does about 2.7 in rev. That came out to EBITDA of about 1.5. So just think the place to start is 1.5. This is a practice, a pretty lean and mean practice with really good margins. So 1.5 of EBITDA. There's a whole world of EBITDA and add backs and what that calculus looks like to you versus what it really looks like to some of these firms. We'll save that for probably an entire podcast. So 2.7, 1.5. The acquirer is on the larger side of a super RIA that you would know. That in this case happens to be backed by two PE companies that are very patient and supportive of advisor culture, and they're really good players. So this offer was a full purchase that came in on the high end. So they came in at 8.3 times rev in the offer. And this is after a few conversations with the buyer. That came out to also 15 times EBITDA. For a practice this size, we usually see between 10 and 13-ish would be fair for what would be good market value for a practice like this. Very fast growing practice. And that's why they commanded. They grew from 100 from 0 to 400 million in AUM in about 5 years, a little bit less than 5 years. So they are a high growth shop, therefore they commanded a higher multiple. Um, there's also a part on top of it. So that came out to be a 22,600,000 valuation for what's called consideration, which is upfront payment plus earnouts. And I'll show you the other components of an offer. And the way that's paid out is typical to deals like this. But they also added in what's called a successor program, which is a third or a second, depending upon where you're at, bite of your apple, where built into the deal, when you do want to retire, that added, they prearrange something between you and your G2 so that if there's a million of compensation coming into advisors for you, for your practice, and you want to get it in the hands of a G2 without them getting crushed because they got to get a loan to buy it out at market value, you've already gotten yours bought out at way above market value, but you can get another bite of the apple by saying, hey, G2, I'm not going to give you this, but because you build your own deal within this deal, but we'll split my million for 5 years, for 8 years. So I'll get 500, you get 500. That added to the deal another 4.3 value. So the total potential opportunity for this 2.7 practice came in at 26.9, John. Very, very strong. And then the way that's paid out is in chunks. So most of these deals, here's kind of the form of it. You get an upfront payment in cash and a percentage in equity with most firms. That's usually about a 70% cash, 30% equity. That's at the time of close. And then in this case, that came out to 12 million, or about 8 times closing EBITDA. Of that, 8.3 million was cash, and 3.7 million was equity. That 3.7 million of equity, in most of these deals over a future 10-year time period, if growth stays the same and it's actually moving faster because acquisitions are moving faster, but assuming it's the same growth, if this whole deal is worth, say, 22 million, it's not unheard of to see the equity portion being worth at least that amount and more. We'll come back to that in a second. So that's what was paid out up front at the close. So the close, 8 million plus in cash, 3.7 in equity, and that's kind of year one. And then in this particular deal, on the 60th day following that, there's what's called the first retention payout. So as everything comes over, what they do, the firms, in this case, this firm has two retention payouts. And all you have to do basically is be at what you were at your 2.7 when you started at the time that this is paid out. So there's two of them. Both of them are for 2.2 million or 1.5 times EBITDA. So one's paid on the 60th day, and the other one on the anniversary again of 60 days past that. So those are two retentions. So again, that's still a pretty short-term time period. Up front, then 2 months after, then 2 months after you get another check if you equal the 2.7. So even if there's a market correction, because you're going to have some growth over that period of time with new clients, and a lot of these companies will also, if you don't hit a payment because the market went down, they'll allow you another period of time to do it. And that's the case in this one. So that's another 4.4 million. And then there is a growth earnout paid. And that rewards growth. That's at 4 times EBITDA. That's 6 million. So this firm got a really good upfront multiple because a fair amount of cash was put into this growth piece. And this is based upon a CAGR, or annualized growth, that is 6 million, paid at a 10% CAGR. So that's what they need to hit in order to get it. It's not all or none. If it's 5 or 5.6 or 6 or 7, they still get paid something in there as well. So that's the structure of the deal. So all of that, if you add it up, that's called consideration. That's the 22 million. That's what they're paying you for the business, as long as you retain where you started and as long as you grow by 10% to get that big check. That's only one part of the deal structure. Part two is payout. Payouts vary from anywhere from 20% to maybe 35%. Why? Because you've gotten your $10 upfront at capital gain rates. You've chosen to do that instead of receiving $1 a year for 10 years at ordinary income. So if you got $10 today, you wouldn't expect to get the full dollar because they're basically paying you now for forward earnings down the road. But you don't get nothing, you get a payout. Most advisors with growth get back to what they were earning. And in this case, with this company, you have no expenses. So they assume your expenses. In this case, the payout is 30%. So as you grow, your income can grow as well. So that's the payout. Then the last part of this is the equity part of it. So that 3.7 you got, There's usually windows because over time, some of the private equity firms sell their position, new ones come in this case. But the average firm like this has some kind of monetization event every maybe 3 to 5 years, and a window opens up, and whatever terms, in this case, it's all, as John said up front, all the same share of class of stock. So it's one kind of partner model. This is a very good offer. I know this is one of the top ones my client is reviewing. They'll get 6 offers in their case and have a lot of choice about what they do. So I thought that'd be helpful, John, just to kind of walk them through that. Any kind of ahas on your end about that?
No, that's just that's a really good offer that you've gotten there for them, and I think I love what our partner Ted likes to say. There's sometimes you get an additional kicker on the valuation because you're in a D1 school. Your marketplace is basically a solid marketplace that the firm's trying to get into. They may not have somebody there, or they may have somebody there that's not as strong as what you are, and they throw in a little extra turn. And keep in mind, there's a little bit different when you talk about payout versus market or a multiple. That multiple can only turn by just a quarter.
Hmm.
So instead of it being six at 6.25, that quarter makes a huge difference versus just a little bit of a change in a payout.
So he's going to get another turn or a turn and a half by saying to the company, I'm going to bet on you and I'm going to bet on me to accept a higher hurdle in order to get my X million for that growth piece. So there's a lot to do. We always want to have you understand the math, because if it's purely math, you would want to get as much upfront as possible, because you want to put that money to use. You want to get as much of that $10 up front at cap gains as you can, because you'll get time value of money, velocity of cash. But that's not always right for everybody. In some cases, it makes more sense to put pressure on some of the other parts of the compensation. And that's always part of our negotiating process with our partners. It has to be a win for them and has to fit within their economic hurdles that they've got ahead. But right now, they have pushed those really high because they see the opportunity with this consolidation and value expansion for clients. So they are very aggressive. We've seen valuations plateau a bit. And so this would be the time to really pull your head up and look at this. And we're at probably a period of time, John, of maximum uncertainty with all that's going on in the world and the fact that we're at all-time highs in the market, all-time highs in valuations. So, smart advisors right now are poking their heads up to say, hey, maybe I should at least explore, what the alternative to doing this myself in an industry that has a lot of threats and consolidation, and they are, relevancy and all of that. So, John, from today, any big ahas you want to leave people with as we close things up?
Yeah, I think just being able to explore makes a lot of sense. Why not take the approach of, well, what's it going to hurt for me to pay attention to opportunities that are out there? A lot of times you're just grinding your heads down, you're doing your job, and you're doing it really, really well, and you never really just stop to take a step back and say, wow, what have I got? So taking that step back right now is probably a good idea.
Just don't wait. Start to explore. It's kind of like in life where the things we tend to regret, John, are the things we didn't do, not the things we did. And we have story after story of clients that we don't say, I told you so, but they come back to us and they say, I should have listened to you, 3 years ago or last year, because this happened now, and fill in the blank. So don't wait. To help you decide if you want to explore this, we'd encourage everybody as an action step to go to our website. It's lots of great stuff. It's www.jptdpartners.com. Subscribe to get on our list of all sorts of cool stuff that we send our clients. There's 2 great resources that are relevant to today to check out. One is there's a checklist on the site of, it's called the 2+ years to sale checklist. So you're 2 years away from perceiving that you may want to take some chips off the table. We have a checklist that is kind of a summary of the things we talked about today. So check that out. And right on the homepage, there's also a button you can push if you want to see what we think is the potential market value for your practice now as you're constructed and as you've grown. You can do that and we'll get you that as well. So hope this was helpful. John, always fun to spend some time with you, bud. And you all, thank you for being on it. Thank you for listening to us, and thank you for staying on. And happy growth. Signing out from JPTD Partners. Thanks again.